investing in futures, Mikey, this is something that until the last couple of years, I don't think necessarily went hand in hand. If you're going with the timeline of futures, hundreds of years ago, futures contracts created for farmers of rice, farmers of corn, all these different things to hedge their production. You bring it into the 20th century, and you've got banks, institutions, financial institutions, not necessarily agricultural institutions, using futures to hedge exposure in their books and everything else. You bring it here into the 21st century, the small exchange, we're bringing futures for the everyday trader to not only hedge, but speculate, invest in everything else. This one doesn't get as much shine as speculating and hedging necessarily, but it's actually really easy to invest in futures with the small exchange products, right, Mikey?
Yeah, and I think it's a decent idea. Most people refer to stocks when they're talking about investing, but you pick up a book like Market Wizards or you read something about commodities and you tend to hear that they actually trend. And we've seen this. You look at something like the US dollar, we'll talk about in a little bit. You can pull up the index prices on the Tastyworks platform, FX:SME. You look at a longer term chart there, that thing has moved in the same direction for the last few months. So why not consider futures as a viable option for investment, whether you're going short or you're going long?
Not only that, but I don't know if people know this, but even traditional portfolios or traditional investment funds, mutual funds and everything else, have parts of it set aside for bonds or cash, which is essentially, depending on where you're living and where you're investing in that fund, US dollar investment there. So all these different things, people investing in the 80s and 90s, of course, no one was predicting that people were investing in Dogecoin. So the different markets that you're investing in, hopefully know no bounds, not excluded to stocks, and hopefully the product types, not excluded to stocks and ETFs, because I think this is something that is hard for people to get over. Futures exist and they have such great efficiency. We're going to get into that efficiency here in a second, because when you buy a US dollar future, Mikey, you aren't necessarily owning US dollars. You have the exposure. So in your portfolio, if US dollars appreciate, your account is appreciating with that, but you're not actually owning the US dollars. With that being said, you are afforded extremely high capital efficiency for that. Because if you want to own US dollars, just go take out a bunch of cash or leave the money in your account, but you're paying for every single dollar. Similar with stocks, everybody wants to own Apple, own Microsoft, own Tesla and everything else down the line. But when you choose to own it, you have to pay 50 or all of 100% of that asset. Futures allow you to, in theory, buy Apple, Tesla, Microsoft, all of those names, I think, actually in our small stock 75 futures for a fraction of the cost. Yes, I don't get to go out to dinner on a Friday night and be like, well, actually, I own part of Tesla. But that crap's, I was about to swear, that crap's overrated anyways. Your couple of shares will appreciate the same as my futures. I just had to pay less, right?
Yeah, it's a great point. And I've even heard of people trying to get around this using call options because you have a little bit of leverage there. So you want to buy stock, buy an in the money call, or if you're really gambling, buy something further out of the money. Why not do something kind of similar and get that commodity exposure, that pure commodity exposure, using the futures contract with the capital efficiency, kill two birds with one stone?
Yeah, if you're using options to buy Microsoft or to invest in Microsoft or Tesla or any of these stock names, but you're still shunning futures, I don't know what to do for you at that point, because if anything, futures more consistent exposure and in most cases even higher leverage than trading the options. But let's actually dive into our example for today, because small US dollars, as we speak, seeing a huge rise here today, and a nice bounce off of the Fed activity on Wednesday for the short-term action. But I want to talk about investment here, because if you invested in US dollars on day one of 2021, they're up, but not much, Mikey. And what's really nice about that US dollar product being up slightly is that if I'm afforded this great efficiency, I could potentially have large returns for like, this just looks mostly flat. And we'll look at the returns in a second. And a lot of people say, oh, well, that market, US dollars, it doesn't move that much. It's low volatility. I don't want any part of it. But nice thing about futures, low volatility markets equal extremely low margin rates.
Yeah, this is such a cool factor of futures that you don't get with stocks. It's not like, oh, I'm trading a cheap stock or a low volatility stock, I mean, and I have to put up less capital. Not true. You could have two
Yeah.
stocks that are 20 bucks, one high volatility, one low volatility. You're going to put up the same amount of capital to
Yeah.
buy those shares. With futures, you actually adjust that buying power requirement based on the volatility, which results in a dollar product, SFX, that's so cheap to trade, $182 for US
Yeah.
dollar exposure. You're controlling $15,000 in notional exposure. It's incredible.
A small amount on an actual dollar basis there. I think most people who have traded futures before looked at it would say, wow, initial margin of $182. That's
Mhm.
kind of unheard of in the futures world. So nice small amount there. You look at that percentage requirement, and I don't think we can create a smaller percentage requirement to trade 1.25% there, Mikey, relative to you want to invest in US dollars in the ETF space, 50% capital
Mhm.
requirement. Some places 100%. You want to invest in the cash market, the physical asset, that's 100% requirement. With the futures, 1.25%. And this is where this really kicks in, because we don't want people saying that's a low volatility asset class, so I don't want it. You
Mhm.
want every asset class that adds to diversification. But if I have to put up 50 or 100% to trade US dollars, then I'm looking at a 1% return on the year. Whereas you stack that up to like Moderna's movement this year, some of these single stocks, some of those cryptocurrencies. And I can kind of understand like, man, 1% return on something I have to put up 50% of, that stinks.
Yeah, there are better opportunities out there, right? You're going
Yeah.
to look elsewhere because you're always trying to find the optimal return on capital. Great thing about futures is that return on capital is adjusting based on the margin. So it's taking into effect all these factors, the size of the product and the volatility. So if you're trading US dollars in ETFs or in futures, you're going to get a much higher theoretical return on capital with the futures. And sure, it can cut both ways. It's important to know
Of
that.
course.
But from a trading perspective, I mean, that's part of the game, right?
Absolutely, man. And what's really nice is we crunched these numbers this week, just you and I, and looked at the fact that a 1% return in the ETF market for US dollars, that reflects, 2%, because I get 50% off of that product. So yippee, hooray. I went from 1% return to 2% return because I don't have to put up 100% of that product. With the efficient margining of the small US dollar, that 1% return translates right now from January 1st to now to almost 80% relative to the capital you put up for that. Of course, that cuts both ways, Mikey. But I think a lot of investors out there looking to take that short-term turbulence of it going forward against you and just saying, hey, I think US dollars are moving higher in the next year, in the next couple of years.
Mhm.
And I don't want to, at the end of the year, check in and see 1%, 2% return relative to my capital. I want to see something that is efficient there. And futures give you that, whether it is, today's example is currencies, of course, but we've looked at this for investing in yields. You know, you think yields are going to go higher. Once again, that's a very similar asset class where it's like yields might be up just a couple of percentage points at the end of a given month or year. And if you had to put up a bunch of money to invest in bond ETFs or what have you, you're not seeing the returns. It moves across asset class here. And so that's why investing in futures is a very, very viable strategy.